All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I'm hopping onto this stream here. I have not prepared anything, like I normally do. I don't have notes in front of me. Just thought I'd hop on and take a look at, just some of the stuff going on out there. Give you some of my thoughts in terms of, trade and, some of the things that, I tend to do on a weekend. I'll do a little bit here on this video and, go and take a look. I know it's always, what's the next trade and what's the reading of this and that and the other. But for me right now, I've gone through a lot. There's not a trade that stands out that screams my name that says, hey, Jeff, go get in right here, right now, here for me. There's some temptations out there, and ironically enough, most of the temptations are on the upside. For example, an IBM, right? And we've talked about how, okay, yes, the market needs a correction, but are we going to go from upper to lower band and find a consolidation range more than we're going to have a flush, right? Something similar to right back here or right back here, these common kind of pullbacks to the lower bands. And we still have, in many cases, the bands contracting. And so, do I step in and buy something off of these lower bands? And, that's my biggest temptation. Now, it's not exactly overly compelling, here with it. I mean, if we kind of look at things from different time periods, here's an hourly look at IBM. We're still below the 7-hour moving average. We're still, slightly oversold, but nothing too major. It's still lower highs and lower lows throughout the month of March, right? There's nothing screaming, hey, you know what, something's changing right here that, it's ready to bounce off of this level. And in fact, if we go into a weekly chart, we can see IBM, like many other stocks, it's breaking below the 7-week moving average. And that's one of the big things that I expect that I will see as we go and look. Now, I'm not totally sure because I haven't looked yet. I'll do that here on the stream. But I suspect we're going to see a lot of stocks for the first time this year with a breakdown below the 7-week moving average. Now, what does that mean? What breakdown below 7-week moving average? Is that good, bad, ugly, bearish, bullish, neutral? Well, bottom line, we never see any big, bad sell-offs without a breakdown below the 7-hour moving average. What a move below the 7-hour or 7-week moving average says is the probability of further breakdown is increased. It's elevated, right? And we will go through periods of consolidation where it'll slap up and above and, up and down, above and below the 7-hour. But generally, when it's had a week like this, breaking below the 7-hour moving average, generally there's further selling to come. Now, occasionally, we've had periods where that's not the case. This isn't a be-all, end-all type of thing, but it just says, hey, odds, probabilities, significantly greater that there's going to be further selling here to come. And so when I have an hourly chart that is bearish, right? A daily chart that is on an interesting support level, and a weekly chart that's saying, hey, the odds of going down are significantly greater than what they have been, are the odds really all that in my favor buying right here at this moment, right? And the answer is no. So for me, what I need is at least for an hourly chart change, right? Now, give me something on the hourly chart to sink my teeth into or to trade off of. And that's kind of where a lot of these, like an IBM, okay, yes, I'm tempted to get in. I'm tempted to jump in. But give me something on the hourly chart first, at least that. And I suspect, like IBM, a lot of other stocks are going to kind of be in that same way when looking at them from an upside perspective, from a bullish perspective on this, on this pullback. And, it would not be out of norm to see some snapback in some of these names, to see some sort of, even sharp snapback in some of these names. And, in many ways, the type of snapback tends to dictate whether we have more selling or not. And so we'll kind of see how that plays on out with a lot of these names. But when we go across the board, in some of these tech areas, Apple's not quite at the lower band, but still kind of same elements, same concepts as IBM. Here's Microsoft, not at the lower band, right? But here at the 20-day moving average, but similar concepts to IBM, but you can see the weekly isn't breaking below the 7, here on that, at least not yet. But there's going to be, yes, a little bit variation in the picture for a lot of things, but I suspect that most things are going to be kind of similar. But let's go take a look at the number of stocks breaking below 7-week moving averages this week. And I'll come in and I'll just use one of these scans here. We'll modify it. But let's come into all right. We'll come into this one here, and this is a 7-day moving average crossover. So it's looking for stocks that are moving above or below the 7-day moving average. But we could just quickly change this to weeks, right? And basically come in and say, hey, 1 week ago, the stock was greater than the 7-week moving average, right? So we'll go 1 week ago, it was greater than the 7-week moving average, and now today, 0 weeks ago, it's less than the 7-week moving average here on it. So we can, we can make this, make this kind of give us those crossovers, and let's see here, 231. Now, whenever I run a scan, first thing I do is I go and take a look at some of the stocks, right? What do I want to see? I want to see if they're actually doing what I scanned for, right? So, here we go. Here's AMD. Here's a weekly chart. Breaking below the 7-week moving average. Started the week above the 7-week moving average. Ending the week below the 7-week moving average. Okay. It's doing what I'm scanning for. Is General Electric doing that? Yep, it's doing that as well. So, okay, the top two are doing that. Let's go take a look at two more for kicks and giggles, make sure. Bank of America is doing that, and Micron is doing that. So we have 231 stocks breaking below their 7-week moving average. This is in the S&P 500. So 46% of the S&P 500 breaking below its kind of that midterm momentum point. This is a huge number. It is a monster number out there, and we typically don't see a number this high on one single week really come into the market, and I think if you're going to make a bearish case on the market, this is one of the best numbers to go and look at and to say, hey, odds are strongly in favor of the bears. And you can just see, the stocks. I mean, it's Ford, FCX, Twitter, Citigroup, Schlumberger, Devon. I mean, if we come and break these down from sector, we have communication services, consumer discretionary, big chunk in here, consumer staples, a smaller chunk in here, energy, a decent chunk, financials, financials strongly represented in here, where we have most of these financials. We have a big representation from healthcare, big representation from industrials, decent from materials, decent from real estate, and then the rest here are going to be technology and 2 utilities. This is broad-based. This is, this isn't 1 or 2 sectors. This isn't 1 or 2 groups driving things. This is en masse. This is money outflow from the market en masse, not highly differential selling here and there, based on a little bit of news or a little bit of, price action. So this is one of the, broader more significant types of breakdowns that we have seen in quite some time. Does it mean you just go out and short any one of these? No, it doesn't. But you'll notice IBM on this list and kind of how I look at it there, right? And so it's one where, all right, if the other time periods or I get a signal on it, or, for me personally, okay, which one of these stocks are on my watch list? And I need to look at them a little bit differently going forward, and maybe look at them in a mode of selling a rally rather than buying a dip. Right? So here's IBM, and it's easy to say, hey, let's go buy the dip. But maybe some of this switch suggests that we should be in a period of selling a rally rather than buying a dip. Yesterday with Microsoft, sold a rally rather than bought a dip. And that's a mentality that I think is going to have to shift here, or is going to shift for the market over the next little bit. Okay. So we see that happening out there, and it's just across everywhere, with that breakdown. And we could come in and change this scan up and look for stocks breaking below the 20-day moving average. And we're going to get a similar number. So, in fact, let's come and do that. Let's come here. A week ago, it, went below the 20-day moving average. So a week ago, the stock was greater than the 20-day moving average was 1 week ago. Okay, so these are stocks that are above the 20-day moving average last week. Let's see here. No, that's 20 week. Yeah, it's not going to let me offset it on this scan. But I have to get into the technical expressions. I don't want to do that here on this video. But overall, it's going to be a very similar number here with that. Now, earlier this week, I put up a video that I had done a long time ago on 3 different indicators and finding a setup based on these 3 indicators: the stochastics, the MACD, and the RSI. And I mentioned we'll probably see a lot of these, as we go forward here in the market. And where we get this element of MACD crossing down, RSI pushing below 50, and the slow stochastics pushing below 50. Now, it's not happening on Microsoft, okay? It's not happening on Microsoft. All we have is the MACD. But here this week, when we go through, and in fact, I'm just going to put all these indicators on top so we can see them a little bit better. But here this week, there are a lot of stocks that kind of have this evolution coming into them. Here's Micron, below 50 on the STO, MACD bearish, RSI pushing below 50, right? This type of picture coming in, in just so many different arenas out there in the market. Some of them, like Twitter, it came in earlier, back in February, and, it's kind of stayed in an overall kind of small bearish mode. But, many are fresh. They're new here this week. Something like a JP Morgan. MACD crossed last week. Stochastics on RSI crossed down here this week. And in that bearish type of position. And what is this, this kind of group of indicators? This group of indicators is good for recognizing new emerging trends and, the trends that are developed or starting to develop. It doesn't call tops or bottoms, right? It looks at, trends developing. So if we take some of those stocks that are just starting to trade below the 20-day moving average, or excuse me, the 7-week moving average, and we start to look at them, RSI on FCX has gone red, MACD gone red, stochastics gone red. Oh, we have a lot of red indicators across the board as these stocks are falling off. And we can see these in a lot of groups, a lot of sectors, from transports to materials. Here's FedEx, it's doing that, right? And so we have a lot of these breakdowns where, on the week, we can say, hey, you know what? the bears have taken control in a way that they absolutely have not had control the entire year so far, right? One of the things I've talked about is the VIX, and not necessarily the VIX itself, but an increase in volatility coming into this market, where we are going to see, just bigger moves, bigger chops, happen. And one thing to keep in mind when that happens is it happens in both directions. The volatility on the way up and the volatility on the way down, tends to be substantial, right? You don't get huge dips in a bull market that's just grinding higher. You do get big rips in a bear market that pushes lower. So if we're looking and we're saying, all right, most of our indicators are suggesting a bearish turn in the market right now, that this week has created this kind of new environment. One thing we have to realize about that environment is it's almost easier to be bullish in that type of environment than just a normal bull market environment. Normal bull market environment, you're going to watch your stock go up 0.2% every day over the course of a week, and every day be wondering, oh, do I hold it? Do I hold it? And your option value is going to barely tick on up. In a more volatile market, if something like an IBM, if you go and you grab it and it has that day or two of snapback, just back to the 7-day moving average, your option value is going to get plenty of appreciation. Right, so there's that there's that element that comes into play when the market makes this kind of shift, and that has to be accounted for, has to be realized, and it does add to some of the risks in terms of some of the short-term timing. Where if you're you can be right, you can be right about a stock going down. You can be spot on that FedEx is going to break on down, but man, you know what? You might have to weather a bounce or two that look pretty fierce, that look pretty sharp overall. So, you keep that in mind. How do you deal with that? How do you manage that? Well, for each person, it's a little different. For me, it's a matter of just knowing that exists, and then, risk-reward exposure, and just kind of condensing everything down into that, into that format here of risk-reward exposure. I also think it's very important to keep an eye on volumes for S&P futures. Not because of trading the market, not because of saying, oh, I want to trade the SPY or I want to trade, what's happening here. But there's just two things you can take a look at that are going to give some guides, right? So yesterday morning, I got on video. This 20K volume happened. When 20K volume comes in after a dip or a rip, it normally marks the top or the bottom on the day. By top or bottom, I mean an area in the market that the market's not going to be able to close below or close above. So if it's on the upside, market's not going to close above that level. If it's on the downside, market's not going to close below that level. Okay, so the market's going to have a very difficult time, and it's a very accurate number. And it just, we see it. It doesn't happen every day. It doesn't happen all the time, but it does happen a little bit more in volatile markets. Okay, and we saw it yesterday. And what happened? The market grinded on back off of that level. Now, you'll notice that, I wasn't willing to, and I got on video, so I'm not willing to buy puts right down here. Just not willing to do it. Not on the day. I'll wait till the end of the day, because the chance of my put going my way throughout the course of the day is pretty low. So why put the risk out there? But after a bounce up, well, now it changes a little bit. Yeah, there is some downside on the day. It doesn't mean the market can't go up on the day, but at least there's still some downside potential on the day to where, okay, you know what, it starts to make sense of adding some puts in. Got to the end of the day, I wasn't nearly as keen on adding, because here we are, market slips below this 20K mark. magic. I mean, just absolute magic, right? Rallies right on back to that 20K mark. It just happens, way too often. And so watching this and understanding those 20K marks can just help with some of the short-term timing to be able to just say, you know what, okay, yes, the market just fell off, and you know what, everybody's anxiety is going to be high. Everybody's, the trader angst, and oh man, well, why am I not in that? Why am I not in that? Why didn't I get in that yesterday? Right? That mentality. How many of you have that? An hour after the market opens, you look at the market and go, man, why didn't I get into that yesterday? Right? Everybody has that. That's that's just one of the irrational fallacies that the market creates, and so everybody's looking and going, man, why didn't I do that yesterday, instead of looking and going, okay, what's going to happen going forward, right? And so you can kind of be able to look at some of these marks, be able to step back and say, okay, let me step back for a little. Let me let things settle out in order to look for an opportunity to step in. Then there'll be days like today. There hasn't been a big volume, a 20K volume mark. There's not been any sort of bottoming volume come into this market. So I can't go out there and some of this stuff that may be a little tempting to the upside, to pick up. I can't go out there, pick it up right now and feel comfortable about it. Yeah, this morning I put a little bit of a call lotto on IWM personally that expires today. And, it may do well and it may go to zero. Who cares? I'm not even watching. I'm not going to watch it. I'm not going to manage it. I put a very little bit of some of my gains this week, and boom. All right, we'll see where it is at the close, right? But to put on a real position, to put on something sizable and say, you know what, the market's not going to break these lows, can't do it. Just absolutely can't do it here today. Okay, and so keeping an eye on that bottoming volume, very important in kind of just helping to set up positions. Another small thing to kind of keep a look at, as the market gets more volatile. When small caps are outperforming on the day, there's just a greater chance of rally into the close. When small caps are lagging on the day, there's a greater chance of selling into the close. So you look at something like today, small caps, IWM, they're down 60 cents. They're down about, here, let's put it in percentage terms here. The IWM, it's down 0.4. The SPY, it's down 0.7. Okay? So small caps are outperforming on the day. Just a little bit. What's that tell me? There's a greater chance of a little bit of a rally into the close than a little bit of a sell-off. Notice I said greater chance. Notice I didn't say, oh, well, of course, the market's going to rally into the close. Absolutely, that's the be-all, end-all. No. But when we're looking at odds, when we're looking at probabilities of what could happen in the future, that tends to be a decent indication of, okay, market rally or drop into the close. Yesterday, when I bought Microsoft, IWM had been lagging. So, okay, you know what? The odds a little bit more in my favor of some selling into the close. Now, we got a little buy up into the close because, some of that selling actually happened earlier. But, looking at that relationship could just give you, hey, you know what? Where are some of the odds, right? What are some of the probabilities? It's not going to say that, Chinese Premier isn't going to come out in the next 5 minutes and make some sort of announcement that's going to send the markets 300 points one way or the other. It doesn't say anything about that. All those types of future actions and future possibilities, they're still all possible. They're still all, in play, and they could create change, right? That's the market. The market is change. It's constant change, right? It's about change. That's what the marketplace is. And so, as you kind of look, as you kind of go through, as I kind of go through here this weekend, there's going to be a very clear story and a very clear theme of breakdown this week. Now I'm going to have to ask myself, okay, Jeff, go for it and look for a big breakdown, or look to sell into a higher or lower high? Because we don't have a lower high, right? In the short run, we don't have a lower high. In the longer run, we possibly do. Right? In the longer run, we possibly do. But in the short run, we don't have a lower high to deal with. So if I go out and I go and load up on puts into the weekend, I could wake up Monday and be very happy. I could also wake up Monday to a gap up that sees a flush of money come in very quickly that doesn't find resistance until 280 on the S&P. Those are the possibilities. Those are just some of the things that would be normal, in this type of situation, in this type of scenario. And so I have to ask myself those questions and say, all right, does some risk reward exposure, is it warranted, here in this environment, and as far as a fresh, brand new trade entry, right here. For me, one on the market, no, it's not warranted. It's not, I don't have anything that's, good enough from a risk-reward standpoint. If I get into a put, where's my stop on the upside? If I get into a call, where's my stop on the downside? There's not a good level when it comes to the market. There's just not a good level at all for me to feel comfortable with, right? Maybe if there's a rally, okay, now I can start looking at retracement levels and say, okay, I can use some of those, and I can start buying puts into a rally. And if there's a further sell, I can start looking at, some of that. And that's on the short term with some short-term options. On a longer-term basis, the retracements start to come into play. And if we retrace this rally, you will notice that the market is nowhere near its retracement levels. And I'm sorry, but I would be very shocked and very surprised if at some point in the future, could be near future, could be later on in May, June, but at some point in the future, the market does not come and retest this 262, 265 level on the S&P. That would be the initial retracement. That would be these high volume marks that we saw in October, November, December, where we saw this mass volume. And you'll notice we even had a bump up in volume when this level was hit back here in January. So the chance of the market not going and hitting that level again with all that volume there, it's very small. At some point, I expect it to go and hit that level. Is that going to be Monday, Tuesday, right? So if you're getting into a weekly option, that's the question you have to ask. If you're getting into a longer-term option, well, no, you can ride a little bit before, getting on down there. But that's the level that comes into play. If there is no trade deal, I don't think the other levels matter. If there is no trade deal between the U.S. and China, the other levels won't matter. With what we see with the economic data, if that element of no trade deal comes, the lows from December won't stop this market. They won't stop it at all. There's too much erosion in the earnings. There's too much erosion in the economic data to basically say, no trade. No trade deal. Okay, that'll just be a 10% pullback in the market. No, because the hope of a trade deal has kept the market pushed on higher, right? This first one in January, that's just taken off some of the overreaction to the downside. That's all it's doing. But this last move has happened in the face of eroding economic data and after an earnings period that, showed some warning signs about the future. And we've seen the market take a big tag up and basically on hopes of trade deal. If that doesn't happen, not only does this leg end and this leg go away, but now the market has to start pricing in the eroding economics, the eroding earnings, which it hasn't done. The rally has kind of kept it from pricing those things in. And that is a huge negative. That is a huge kind of element for the market to have to deal with going forward. If you look and you say, well, how do you monetize that? How do you take advantage of that? Well, I don't think you can play for that, right? You're playing for, I don't think you play a normal position for that and just say, oh, well, I don't expect any trade deals, so market's just going to tank. But you can set up a little bit of a flyer, a little bit of a low risk gamble here. If we talk about the S&P coming back and retesting these lows, 235, 237, 240, right? And you start to come out to some September options. Here's the 235s. They're going for 360. I mean, they're ridiculously priced, right? I mean, they're going for $3.60. A delta of 15 cents. I mean, you basically, to break even on this option, to break even on this 235 option, you need the market to go down to new lows at 232 just to break even. 229 to double your money. You basically need the market to collapse to double your money. And it's not like you're just paying 10 cents to make that trade. You've got to put in 350, 370 to get into this trade. It's ridiculous. What about a spread? All right, can you do a spread here? Can you do something like 240 to 235? Well, 240s are going for 435. 235s are going for 370. It's still going to cost you 65 cents to get into this spread that could possibly be worth $5. So, 65 cents for something that could be worth $5. Okay, you know what? That's not too bad. It's not too bad. But what do you need to happen for that to go? You need the market to erase everything from the last 2 months. I mean, they've priced them out. Right, they've priced them out. Now, the prices of these, if there's a small rally in the market, the price of these will change. Because the implied volatility component is such a big one. You can see the Vega here on these is about 50 cents. 1 point move in the implied volatility is more than a 1% move in the option. That's just a huge number. Right, so if the implied volatility drops over the next 3 days, these options could literally be cut by 30% with the market not barely even moving. So they're ridiculous to go out and buy right here. But if we do see a small rebound, small rally in the market, Monday, Tuesday, Wednesday, the prices on these are going to come down drastically. And then they'll be interesting. Then they'll be, okay, do you want to set up a play? Now they're worth kind of taking a closer look at. Okay. So anyway, those are worth kind of keeping an eye on, but not worth, anything, as far as an entry, in my opinion right here. But something, something to keep an eye on as we go forward. I think if you want to make a big, bad, bearish bet, and you want to be uber bearish, and you just want to say, hey, things are going to go to a hell in a handbasket, you play it with the FXI. And, if there's no deal with China, the FXI, it breaks its lows and it goes much, much lower. We may even be talking about 2016 levels coming in, if there's no deal. It will significantly impact the global economy, but it will impact China on a scale that, just on an overall scale is greater percentage-wise than it will impact the U.S. It will also have a big impact in Europe. It'll have a big impact in India, a big impact in South America. It will have a global impact. But if you're looking at what could underperform in a huge way, this FXI is, one of those areas where we could see that. And the FXI breaking below the 7-week moving average. EWZ, Brazilian ETF, broke below the 7-week moving average last week. Continuing on lower here this week. I've looked at a couple plays that possibly play in this lower. PBR, Petro Brasileiro here, Petrobras, and do I play it with that? Vale, I don't think is in play for playing Brazil. This has its own stuff going on. It has its own drummer right now with the dam burst and some of the executive shakeups. But Santander, some of the other companies here, you can see Banco Santander breaking below its 7-week moving average here as well. Another area, and I priced these out yesterday, and I didn't go get in, but BHP, Rio, these have held up remarkably well this week. They created some topping patterns last week, and they have held up in the face of an FXI, a China market that's dropped, U.S. market that's dropped. These have held up phenomenally well here this week. Makes it difficult to go and enter them on the put side right here. It suggests new short-term high will come into play, but I do think on that new short-term high, these would be some very interesting short candidates, in that scenario. So anyway, just some of my thoughts as we kind of go into the end of the week, into the weekend. For the challenge, I'm in all cash right now. I would like to be into something into the weekend, but I'm not. I'm not seeing anything that I go, man, this just is. I got to go right here, right now, and get in. So I may just go into the weekend with cash, see what Monday morning brings. I think a Monday morning gap up is buyable. I think if we gap up about 10 to 12 points on the market Monday morning, I think that's a buyable scenario, at least for a 24 to 48 to 72 hour period. Especially with some of the stuff that's a little bit oversold. But I that's if there's a gap up on Monday, and I think it has to be news driven. For there to be a gap up on Monday, there has to be some positive news to come in. I think if there's not any kind of positive news, we're going to be looking at a gap down, because fund managers are going to look at the market this weekend. They're going to look at what this week was overall and go, wow, that is a big change. It's a big change in the metrics. It's a big change in the mentality. It's a big change in the price action, and they're going to be forced to react. And, I think that is something where if you want to make an argument for the market just rolling downhill all week next week, I think that's the argument that can be made. Definitely has some good teeth to it. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.